Hello and welcome to this session in which we would look at this example to illustrate how sampling works and how we can project sampling errors to the whole population. So we are dealing with account receivable. In this example, we are evaluating the results of a non-statistical sample. So this is the non-statistical sample of 85 account receivable. So we are dealing with 85 account receivable. That's the population that we are working with. So 85 account receivable, and the tolerable misstatement is 100,000. The tolerable misstatement equal to 100,000. What does the tolerable misstatement means? It means we can tolerate, so if this is 0, I like to use this is 100,000. We can tolerate mistakes up to 100,000. This is what we're saying. Okay, so what we do in this example, we are going to stratify our population. We are going to stratify the first stratification. It's going to be any account above 75,000, and in those accounts we have 8 types of accounts, and we're going to sample the whole 8 accounts. That's why those accounts are large numbers. They are important. Therefore, we're going to sample everything. Okay. Then the second stratification, the accounts between 10,000 and let's say 75,000 up to 74,999. Okay, we have 257 accounts with a dollar amount of 4,348,268. Of these 257 accounts, we selected 40 accounts in the sample, and this is the dollar amount for the sample. And for the third stratification, which is all the accounts less than 10,000, and we have a lot of them, 712 accounts. Of these 712, we selected 25 accounts. Okay, and the dollar amount is 94,000, and the total dollar amount is 947,682, the recorded value. Now the total account receivable for the whole company is 6,583,593, and what we need to do is we need to find out if that balance is fairly stated. So what did we do? We sent confirmation. And I really like this because in the real world, I used to do a lot of confirmation, especially the first and second year as an auditor. That's what you do. You send confirmation out, and the customer would return the confirmation. And here's some confirmation we are going to analyze. So let's take a look at the responses. So we're looking at account number 147, the first account. So we are looking at account number 147. The recorded value, what we recorded on the books, is 24,692. The confirmation came back as the account should be 22,486. We looked up into this discrepancy, and we found out that the customer was charged the wrong price. Well, do we have a misstatement? Of course we do. If we charge the customer the wrong price and the customer saying, I'm not going to pay you 24,692, we have a misstatement. The misstatement is the difference between those two figures, and that's a misstatement of 1,095. So I'm going to go back to the Excel sheet, and for the first one, there's a misstatement of 1,000. This should be 24,692. So the misstatement should be, we were overstating our account by 1,095. Okay, let's take a look at the second confirmation. The second confirmation, the recorded value is 183,219. They came back and they said, well, we only owe you as of December 31st. Remember, they're looking as of December 31st because the financial statements is as of the end of the period. So what they're saying is, as of December 31st, we only have 157,216. We looked into the issue, and what we found out is $26,003 shipment recorded on December 30th. So we recorded the shipment. The goods were not shipped until January 3rd. What does that mean? On a timeline, this is what happened. This is 12/31. So what we did is we recorded the shipment here, but it did not take place until here. So this is the shipping, and this is the recording. Well, we recorded the receivable before we did the shipment. So we recorded here, we debited account receivable, credited sales for 26,003, 26,003, and this is supposed to take place when we do the shipment. What does that mean? It means our account is overstated by $26,003. Okay. Let's look at other confirmation 278. And by the way, just want to let you know, so the first one is a pricing error. We made an error. It's a pricing error when because again, you want to look into the errors. You want to see why did the error occur, because that's important as you're analyzing the errors. You want to know why did the error actually happen. Okay, so this is a pricing error. We call this is important, cutoff error. Basically, we are recording the transaction in the wrong period. The transaction took place, but not in the year that we wanted it to take place. Account number 278, the value that we have recorded at 7,547, the customer says the value is only 5,546. So the customer sent a payment on December 29th, received on January 2nd. So what happened is this. We looked at our balance and it shows 7546, but the client said, I'm owing you only 5546 as of December 31st. And the client is correct, because what happened on 12/29, the client debited their accounts payable and they credited their cash for 2,000. So they send us the payment. Now we have, so what they're saying is correct for them. Okay, but as far as we're concerned, we did not receive the payment until January 2nd. So as of December 31st, they still owe us 7,546. So in this situation, there is no error. This is called a timing difference, because the check was basically in process. Okay, so what they have in their books, they paid it. In our books, we haven't received it yet. So there's really no error here. Okay, let's take a look at more transaction. Let's take a look at more. And by the way, there's a couple errors in this problem. I will, once I get to them, I will fix them. And I believe this is the first one. So account number 497. This account here, there's an error in the book. So I'm just going to fix the error. What it reads, it's not correct. Here it says 17,000 shipment made. It should be shipment recorded on December 30th. And it should read goods were shipped to the customer on January 2nd. So we recorded it, and we did not ship it until January 2nd. Once again, same thing, same type of error that we saw earlier. This is 12/31. We recorded it, the shipment here. The shipment did not take place until here. So we recorded the account receivable on the 30th of December, but we ship on January 2nd, 1/2, therefore the account receivable should be moved up here. Therefore, what happened is we have another cutoff error here, and the 17,443 shipment recorded, it should be 15,319. So there's also a problem in the quantity, the number, but the error is for 15,319. But here we have two errors. We have cutoff error, and also we have quantity error. But notice here, if you're noticing, we're having, this is the second cutoff error, and this should start to raise red flag, because this is just a sample, and we found already two errors in cutoff, and cutoff is important. Let's look at account number 564. The recorded amount is 8,397. The customer says, we only owe you as of December 31st, 7,858. Do we need to look into it? Of course we need to look into it. Customer received less than the full quantity order. Okay, so when the customer opened their shipment, they receive product worth of 7,858. So we have to change our record. So we cannot bill them for 8,397. That's another misstatement. So we go. So that's another misstatement. The misstatement is for 539. And what is this misstatement? Error in shipment. Okay, so basically we shipped the wrong product. We did not ship what we claim that's on the paper. Error in shipment. Let's look at account number 653. Account number 653, the recorded amount is 32,687. What the confirmation shows, 19,328. Okay? Again, let's take a look at what happened here. This is 653. 13,359 shipment recorded on December 30th. Goods were not shipped until January 2nd. Once again, we have what type of error? A cutoff error. We recorded the shipment December 30th. We did not ship it until January 2nd. And the amount is 13,359.